Hi guys, welcome to our YouTube channel. Today we will share some interesting facts with you about insurance, as like what is insurance and some historical background of insurance practice in England and United States. This video is going to be very informative and expand your knowledge regard to insurance. So let's move forward to our topic and see what is insurance. Insurance is a system under which the insurer for a consideration usually agreed upon in advance promises to reimburse the insured or the render service to the insured in the event that certain accidental occurrence result in loss during a given period. It is thus is a method of coping with risk. Its primary function is to substitute certainty for uncertainty as regards the economic cost of loss-producing events. Insurance relies heavily on the law of large number. In large homogeneous population, it is possible to estimate the normal frequency of common events such as death and accident. Loss can be predicted with reasonable accuracy, and this accuracy increases as the size of the group expands. From a theoretical standpoint, it is possible to eliminate all pure risk if all infinitely large group is selected. From the standpoint of the insurer, and the insurable risk must meet the following requirements, which includes the object to be insured must be numerous enough and homogeneous enough to allow a reasonable close calculation of the probable frequency and severity of loss. And then the insured object must not be subject to simultaneously destruction. For example, if all the buildings insured by one insurer are in the area subject to flood and a flood occur, the loss to the insurance underwriter may be catastrophic. And number three is the possible loss must be accidental in nature and beyond the control of the insured. If the insured could cause a loss, the element of the randomness and the predictability would be destroyed. Number four, there must be some way to determine whether a loss has occurred and how great the loss is. This is why insurance contracts specify very definitely what event must take place, what constitute loss, and how it is to be measured. From the viewpoint of the insured person, a insurable risk is one from which the probability of loss is so high as to require excessive premium. What is excessive depend on individual circumstances, including the insured attitude toward risk. At some time, the potential loss must be severe enough to cause financial hardships. If it is not insured against, insurable risks include loss to property resulting from the fire, explosion, windstorm, etc., loss of the life or health, and the legal liability arising out of use of automobile, a company of building, employment or manufacture. Uninsurable risk include loss resulting from price change and competitive condition in the market. Political risks such as war or currency debasement are usually not insurable by private parties but may be insurable by government institutions. Very often, contrast can be drawn in such a way that uninsurable risk can be turned into insurable one through restriction on loss redefinitions of perils